One of the common or similar aspects of these setups that we're going to look at, though, are that they do all have very attractive technical bearings, but without that fundamental aspect, the probabilities of what we are looking at as a trade setup are going to be somewhat diminished. So as we start off with technical pairs that don't necessarily have a key fundamental catalyst, dollar-yen here, all right? I think the technical bearings are pretty straightforward. You have a nice descending wedge pattern here, and we also have a diminished ATR reading. Now the ATR, for those that aren't familiar, we did do a Forex strategy video on this yesterday, is an indicator of activity or volatility. When we get an extreme low in activity, it typically picks up. Right, we have started to pick up somewhat from these lows, but we haven't at all retraced the significant phasing out of volatility that we've seen over the past 6 months. So this is a continued effort, no doubt, but doesn't necessarily coincide nicely with this technical pattern that we have here, just short of approximately 100. Well, a fundamental catalyst would do well to drive us beyond this upper threshold. Also, a robust push to the downside can help cover a range in a very quick way. However, it's very difficult to force a breakout on this particular pair. That reality should be made clear to us by the fact that we've been having such consistent congestion over the past year or so. All right, actually, I will be fair with this assessment. It's about 10 months. This is an exceptionally long period of time for congestion, and it does reflect that this pair has trouble generating the kind of momentum necessary to force a breakout of that magnitude, or even to go for a very rapid reversal in this range. Back when we were in these major swings, we had more active fundamental catalysts in place. Now, we can look for event risk that could potentially drive these markets to a substantial swing, the dollar-yen specifically. But when we're looking at the event risk, do we see necessarily a U.S.-based piece of event risk or a Japanese piece of event risk that can jumpstart those kind of themes? Well, going into Wednesday evening to Thursday morning, we do have the Japanese GDP. Aside from that, maybe the U.S. Senate confirmation of future Fed Chairman Janet Yellen. That might give us something. But those are big ifs, because these two events do not have a precedence for high volatility, nor are they expected to generate high volatility, much less the level of activity needed to force a big breakout or trend reversal here. Furthermore, the dollar-yen is a confused pair because it has a mixed view of risk trends and the dollar. If we have a meaningful risk appetite move, let's say risk on, that is negative for the US dollar and positive for yen crosses. So naturally, as it's negative for the US dollar, we're talking about a push to the downside on this pair. But if it's positive for the yen crosses, then there's an opposing force pushing to the upside. So this is not necessarily the best currency pair, even though it has a nice technical pattern. Its bearings, and more importantly, its fundamental catalysts simply aren't there. Now, something that was a little bit more interesting in this past session, actually this morning, was the Kiwi dollar. All right, and not just the Kiwi USD, we're also talking about the Kiwi yen. These two pairs have very clean technicals. All right, I think the Kiwi dollar has a little bit more prominent bearing with a nice range support here in a descending trend line. This creates a head and shoulders pattern for the pattern traders out there, and the possibility of a breakout is exceptionally high because you do have a what we call terminal range here, in which you have to either break support or resistance because you have the two lines meeting. Now, breaking resistance does not necessarily mean follow-through. We did have something of a dip, as you saw here, as well as on the Kiwi yen, which did break this trend line tentatively but came right back. This was supported on a piece of data. This had that next step element that was a good possible push, something that we could definitively say this is something we should watch out for. This is something that can meaningfully drive the currency and currency pair. But as you can see, we need something that has substantial follow-through potential. It has to be meaningful enough to actually generate the necessary activity to force the break and look for trend. What we were looking at was the RBNZ stability, financial stability report, as well as Wheeler's follow-up delivery of the annual report and the stability report to the Select Committee in Parliament. These are noteworthy, but a lot of what he said was repetition of the comments about a high Kiwi and the damage it can do to the local economy, as well as uncertainties surrounding the housing sector in New Zealand. All repeats of what we've seen in the past. So while this offered event risk that can certainly catch people off guard, it didn't necessarily do so. This is still likely a pair that's going to look for a break, and you essentially have to in this kind of technical pattern, but the follow-through is likely to be relatively moderate unless something else actually comes through. And if you don't have follow-through, you essentially have volatility that's just going to leak through this technical pattern and essentially give us false breaks, and not really something that's worthwhile of trading. All right, so this is a second step. This actually offers us that event risk and that technical pattern. However, it's fallen somewhat short because the fundamentals don't hold up their end of the bargain. Now, of course, we're building up to the pairs that have the best potential. And I think that a number of sterling-based pairs have exactly that proper combination. This is the pound USD, and as we've been talking about in numerous videos, this is a nice range that we've been cutting here between 62.50 and 159. We are starting to nudge that 159 floor. Now, this is moving without necessarily enough of a precedence. This past session, we did have data. All right, we had the UK CPI figures, which actually came out weaker than expected, which is negative for the pound. It suggests that they can, the Bank of England, that is, be more dovish on their policy bearings and thereby undermine interest rate expectations, which is negative for the British pound. All right, that did push us down to this floor, but you didn't see a full-scale breakout. Is that necessarily a failure of the fundamentals? No, it's not. The data is good and very meaningful, but we have something of a distraction because the market's going to be paying attention to what's on the immediate docket. Beyond that, we have UK jobs figures and the BOE quarterly inflation report. This is going to tap into exactly what the Bank of England is looking at for determining its monetary policy timetables. All right, whether it's going to hike, whether it's going to be a hike in 2015 or 2016. All right, these two events, this data and this updated forecast, are going to tap directly into that uncertainty. Right, this is the kind of event risk that has the clout and the follow-through potential to match up nicely to this technical pattern and to force a big move, whether it be a range reversal if interest rate expectations are supported, or a drop to the downside if they're undermined. We have also the pound yen, which is perhaps a favored of mine. You can see we have this nice closing wedge pattern here on the 8-hour chart. This is approximately, I think, 130 pips wide. A break here looks like a high probability scenario. And if we have that break, not just on a technical bearing, but on the combination of a technical move and the fundamental drive to keep it going, we significantly improve the trade potential of those trades. So it's sometimes difficult to use fundamentals in a trading plan. I know a lot of people have asked me questions on this from different aspects, from different trading strategies and different backgrounds. And there is a long corridor you can go down when incorporating fundamentals into your trading. But this is a relatively basic and straightforward way of incorporating fundamentals and really sticking to your technical backdrop. You're looking for those technical patterns that can give us a break or a reversal, big moves potentially, because they do have those bearings. But then using fundamentals to our advantage to tell us whether this is a high probability break with follow through or a reversal with follow through, or if it's just simply a technical pattern that will fizzle and essentially show a lot of choppy congestion, which has been the case with the dollar yen for so long. All right, when you combine these two elements, you're provided with much better trading opportunities. All right, so this is kind of a video about or for the technical traders who want to dabble in the fundamentals. All right, so hopefully that helps you out in incorporating fundamentals into your trading strategy. We'll do another strategy video once again tomorrow.